You have probably been told that mutual funds are safe, smart, and reliable. Your financial advisor might even swear by them. But here's the truth. They are quietly dragging down your returns, and the hidden costs could add up to millions of dollars over your lifetime. In this video, I'm going to show you the real numbers behind mutual funds, why so many investors are unknowingly falling behind, and how you can fire your financial planner and retire with far more money in the bank without them. Guys, these smart, brilliant, Harvard, Ivy League educated mutual fund managers will sit there and show you, look how smart I am. But remember, guys, as Warren Buffett says, most of us have the financial ability in our brain to do well, but it's the stomach that matters. And unfortunately, in the mutual fund industry, you're not going to outperform because underperforming in a short period of time far more hurt your career than just staying as close as you can to the performance level. People don't get fired by being close to the market. People get fired when they underperform. And there was a study years ago done by Morningstar in which they sat there and looked at which mutual funds massively outperformed in the long run. And what they found was pretty much all of them at some point in a 10-year period were in the bottom 10% of the mutual funds in any given year or for several years. Why is that? Well, if you think about it, in order to outperform, you've got to buy companies that are absolutely hated by the market. When they're hated by the market, you don't know when they're going to turn around. But when you're finding a mutual fund to buy, you're going to look at the recent performance. And if you see a fund in the lower 10%, how likely are you to invest in that? We all sit there and say, we would have found the next Warren Buffett. But guys, we would have never, ever invested in Warren Buffett because his demeanor, his look would not have matched our desire. Now, if you'd seen his performance, you would have loved it, but his best performing years were the first 10 or 15 years. And that's hard to sit there and latch onto that and say, I'm going to do this. Here's another article. A new study from S&P shows that roughly 90% of active public equity fund managers underperform their index, and 81% of active fixed income underperform on a 10-year horizon. Guys, I'm not going to lie to you. I thought it was higher than 90%. But look at this. Guys, what are you paying for here? If you're hiring somebody to do work for you, don't you expect above average returns, above average work? Of course you do. Guys, let's put it in basic terms. Let's say you wanted to hire a contractor to paint your fence. Would you pay a contractor above market levels if they're going to do a below average job? Of course not. Of course you wouldn't do that. Why are you doing it with your life savings? It makes no sense whatsoever. Now you might sit there and say, well, Paul, yeah, but if they're pretty close, that's okay. Well, guys, these funds have fees, and those fees erode at your long-term returns. Let me show you the math because it will absolutely shock you. But guys, before I get into that, this is from the index fund advisors when they looked at year-end performance of 2024 starting 20 years before. Guys, these are the percentages that did not outperform their passive index performance. How is this good? Do you think you're going to be the one to pick all of the winners? Of course not. And frankly, guys, you're too busy going to work, having a family. Why try to spend your time trying to pick the right winner? And if you're wrong, what happens then? You lose out on major returns. And that's where the numbers come in that will absolutely floor you. Over long periods of time, the market will get between 9 and 10% returns. So I'm going to assume 9.5% returns. This is our retirement calculator. What it does is it asks you for your inputs. I've made a couple of assumptions here that probably don't apply exactly to you, but it's just to show the example. Not only that, our retirement calculator doesn't stop at retirement. It says, will you have enough money to even live the rest of your days? So let me show you my assumptions. I assumed age 30 today, retiring at 65, having $100,000 today in savings and saving $10,000 per year. Then every single year hereafter, you increase that savings by 4%. So 10,000 this year, then 10,400, then 10,800 and change, et cetera, and growing. I'm assuming a 9.5% return, 6.5% during retirement, because you probably sell some stocks and be more fixed income. That way you can live out your years. And I'm having you live until age 95. So you have 30 years of retirement here, 65 to death of 95, inflation at 3.5%, your current income at 80,000. And I say you want to give 100% of your income. So you want to replicate your exact income, and it's going to grow at 3.5% per year. Assuming this, guys, you have enough in retirement. Let's actually scroll down here. And at the age of 65, you finish with $6.65 million, which is equivalent to $2 million today. That's a lot of money. Now, guys, I'm going to sit there and say, let's say you just lose 1% per year off that 9.5% and off that 6.5%. Everything else stays the same. Guys, you went from having enough to you need to save $2,600 more per year. And you might sit there and say, that's not a big deal, but let me show you. Remember, we had $6.65 million at age 65 in this first example. Age 65 here, you have $5.1 million. That is $1.5 million loss to your retirement. And guess what? You run out of money here at the age of 90. Now, not a big deal, but that's only 1% underperformance per year. Only 1%. It costs you 7 figures. And I wasn't assuming you came in with lots of money. Now, the reason I keep pushing to fire financial planners is a lot of time these mutual funds have commissions. They have these fees they pay to financial planners. So I asked the question, what's your financial planner doing by pushing these mutual funds? Are they there looking out for your best interest or their best interest? You might sit there and say, no, my financial planner is a great family friend. They're looking out for me. Guys, we're still human. They still need to make their money. At the end of the day, if you think your financial planner is not looking after their bottom line, there's somebody at this table that's a sucker, and I'm sorry to say it, but it's probably you if you believe that. I had an employee I ran into the other day, my first ever employee. I remember back 18 years ago when I was talking to him, he said his financial advisor took a 2% fee. I looked at him and said, you're absolutely getting crushed then. And his comment was, well, I have a good pension, so I don't really need that money anyhow. And I just remember shaking my head thinking to myself, gosh, he's losing so much money by doing that. Guys, Morningstar is the mutual fund company. They rate these mutual funds. And they're sitting here and they wrote this article just recently measuring the performance of active funds against their passive peers. And the numbers keep compounding on themselves. Guys, massive underperformance. In fact, guys, look at this. The 10-year lowest cost ones versus the 10-year highest cost ones. Major differences here. High cost does not mean higher quality. In investing, it's one of the few places where the more you pay, you're probably not getting enough to compensate you for that. This is just all over. If you Google this, this is all over the place. Now, do I believe a financial advisor would be great to help you emotionally during tough times? Absolutely. But why pay a percentage of assets? Pay a flat fee. You might sit there and say, well, I want my financial advisor to do better as I do better. But you're going to do better, not because you're a financial advisor, because of the markets. The markets over time will continue to go up and continue to get better. There's no reason to pay somebody else for that. In fact, there are countless studies in which it shows and it proves that the less changes you make, the less active you are, the better you will do. Now imagine you're a financial advisor and somebody's paying you per year and they see you do nothing all year. What do they think their clients are going to say? What do I pay you for? You do nothing. When in actuality, that could be the best thing they do. But we as humans want to see activity. But if you say, hey, my financial advisor does nothing, why should I pay them? Exactly. You can do it yourself. Save yourself that money. I'm literally handing you potentially multiple 7 figures in retirement by you watching this video. There are ways to outperform the market by using ETFs. And there's ways to decrease risk by using ETFs. I've always talked about this. QQQ is the NASDAQ 100 ETF that has a lot of tech. Guys, tech is wonderful. These are businesses that can grow fast and have a lot of margin. These companies can do very well. Adding this ETF to your portfolio over a long period of time could help you outperform the market. So if you're looking for outperformance, there's still a couple ways to do it. One of which is through buying QQQ. Now, let me give you an example. And keep in mind, guys, I perceive that we're currently in a NASDAQ bubble. But let's look at it this way. In March of 2000, we had a huge tech bubble. QQQ, between its peak and its bottom, fell about 80%. 80%. But here's what's interesting. If you started investing at the very peak and dollar cost average to today, including dividends, you made over a 14% return per year. That's buying at the peak, watching it fall 80% and watching it rebound. Even if the NASDAQ fell by 50% today, this return is still 11% plus, pretty close to 11%. That is massive outperformance of the S&P. The S&P in this time has done roughly 7 to 8%, including dividends. Massive outperformance. Now, I'm not telling you to go put your money in QQQ, because the downside of this is a lot of tech means a lot of volatility. But you can use this ETF to help yourself outperform. Put a mix, a blend, some money in SPY, some money in QQQ, some money in emerging markets, passive ETFs. That's the key here. Now, guys, one of the things I do, I buy large cap companies and large cap ETFs. And the reason I do that is my goals are very different than a lot of people. I've got a lot of apartments. I've got several businesses. I generate cash flow in many different ways. I like to sell what's called covered calls and cash secured puts. Now, you might be the first time you're hearing this. Basically what it is this. When I sell a cash secured put, I am being paid to buy a company I like at a lower price. So let's say, for example, Nike. And I think currently it's at around $62 a share. Somebody will pay me some money that if I want to buy Nike a month from now at $55, they will pay me money to wait for Nike to fall to $55. How much money? I can make 10 to 15% per year on my cash doing that. So I'm literally being paid to wait to buy a company that I love at a much lower price. Being paid to buy at a lower price. That's like saying, hey, I want to buy that car, but I'm going to wait 2 months to buy it. And by the way, I want somebody to pay me to wait 2 months to buy that car at a cheaper price. I've made money and I've saved money. What could be better? Now, is it a free lunch? No, of course not. It's for people who really understand value, what we're trying to teach on this channel through principle-driven investing. Then when I have the stock, I sell what's called covered calls. This basically allows me to rent out my stock. As I hold the stock, I generate income on the portfolio. I generate income to supplement my lifestyle. I get some portion of the upside. So for example, this exact example, if Nike's at $62, I might sell somebody a covered call at $70. They're going to pay me the right to hold this company until 70. If it goes above 70, I have to give them the stock at $70. But I got all the gains between 62 and 70. But the best part is this. I have a portfolio of 28 or 30 companies and ETFs. I can sell it across the portfolio and never get my shares taken away. This is an absolute game changer and something I wish I had learned 20 years ago. But I just started doing it 5 years ago, and it's been absolutely game changing for me. If you want to learn more about this, click the link below. We will email you our options PDF. Again, it's an absolute game changer. We have several people in our community who are doing it and absolutely killing it. So guys, if you made it all the way through this video, you are ready to take the next step as an investor. In this next video, I'm going to walk you through our full course on how to evaluate and buy individual stocks the right way. Because understanding value isn't just how you avoid mistakes. It's how you build wealth over time and ride the market higher and higher and ride your winners higher and higher. So click the video linked on the screen and I'll show you exactly how it's done. Thank you for your time.